Oh, yeah.
Speaking.
I guess I don't really have to cover my mouth when I'm in my room all by myself, but I have a little bit of a cold. So we did this call, Tyson, I think it was about 6 weeks ago, wasn't it?
Yeah, that sounds
And
right.
it's interesting as Tyson and I have looked back kind of at our predictions then and what's happened since then. I mean, things change and nobody has a crystal ball. And so what our plan is this year is to actually do this call the day after every Fed meeting. Because we think that's a really important time to kind of disseminate what the Feds did and adjust our predictions and where we think things are headed. But we also want to use this as an opportunity to give you some tools to really have conversations. You get the questions a lot as real estate agents as far as what's going to happen in the market? Is it going to crash? What about high interest rates, right? So we're going to give you some conversations, I don't necessarily like to call them scripts, but just some really good responses that you can have to those questions that you get quite a bit. And so I'm going to go ahead and turn it over to Tyson. He's prepared some amazing statistics and information for you. For those of you that weren't on the last call, I'm going to introduce Tyson really quick. So Tyson is my loan partner. We've worked together for 4 years now. He's also my son-in-law, so sometimes we talk in a way that might seem creepy, but it's not. But Tyson has a master's degree in economics, and he actually worked in the oil and gas industry for a number of years before I took him over to the dark side and brought him over to mortgages. And he's brilliant, and so I kind of let him take this and take some really technical information and put it in a way that we can understand again, so that we can be the experts to our clients. And I'm just going to chime in now and then with my opinion on stuff. So let's go ahead and get started, Tyson.
Okay, perfect. I think I've admitted everyone, so I'll
And
try
I
to
can
keep
keep an eye on it too.
an eye on that. But all right, cool. So if you weren't on the first call that we did 6 weeks ago, that's fine. This should still make sense. And you can always go back and watch that one on YouTube if you're so inclined. So we'll just jump into what we are planning to do today. So we're going to recap what the Fed announced yesterday after their meeting. We're going to talk about what forces are in play that will continue to impact interest rates throughout this year. We're going to give an update on the interest rate predictions that we made 6 weeks ago, because they have changed. A lot's happened since we talked about this last. And then we'll do a quick housing market update. I know as real estate agents, you guys are really plugged into that part of it, but I just found some interesting stats.
Hey, Tyson, we've got a little bit of background noise. Can you, I think since you're the host, can you mute everyone?
Okay, there we go. If we do want this to be interactive, so if you do have a comment, feel free to unmute and speak up. No one heard that, Bliss, because you're muted. You may want to unmute yourself.
All right, everybody, we want your opinions and we want your questions. So please unmute yourself when you want to ask a question and just shout it out.
Okay, yeah, no offense taken for interruptions in this meeting. Yeah, so that's kind of the points we're going to hit on today. Oh, and also, what does all this mean for me and my clients, or you and your clients? Because you get questions all the time about this, because when people hear, oh, the Fed increased interest rates, no one really knows what that means. So hopefully the things we go over today will allow you to have better conversations, more informational conversations with your clients. Okay, this is a quick review. We talked about this fairly in depth last time, but interest rates do behave according to traditional supply and demand forces. When the supply for borrowing money goes up, rates go down, and then the opposite is true, and then it follows demand. So I just wanted to remind everyone of that the Fed sets the Federal Reserve rate, but mortgage interest rates are different. They behave much differently than the Fed rate. And a quick reminder on what the federal funds rate is. This is what changes when the committee meets. So it's the rate that commercial banks lend and borrow money to each other. So there's certain regulations on how much in reserve banks have to have, compared to the balances of the people that store money in banks. And so every night they take a look at those balances and they actually lend money to each other back and forth. And that's what the federal funds rate is. And that is set 8 times a year by a committee that meets. Sometimes they don't change it, sometimes they do. And that committee is trying to curb inflation, promote economic growth. So they take a look at everything. The meetings are 2 days. And that's what happened yesterday that we're going to talk about. Okay, so this is what happened yesterday. So they did increase that federal funds rate 1/4%. That's the first time they've increased that rate since 2018. So it's been a while. We've been in an environment that they've either dropped it or is held steady for the past almost 4 years. They did announce that they're planning 6 additional rate hikes this year of 1/4% each. Now that isn't set in stone, but that is the anticipation throughout the rest of the year. So most of that was already priced into mortgage rates. Mortgage rates always act in anticipation of what's going to happen. So that's why, even though the Fed rate didn't increase until yesterday, we saw mortgage rates increase quite a bit from the beginning of the year. It was all in anticipation of this announcement. And then Bliss, you had a comment here.
Yeah, so if you've been talking to me in the last week about interest rates, and I have some clients that have kind of been on the fence about locking in and some things like that, I have 30 years experience, and it was of my opinion was that we were going to see rates bump down yesterday because the Feds were going to raise 1/4%, and that was going to stabilize the market. And in my experience, that's happened multiple times. And we also had the uncertainty of Ukraine. The opposite happened. We saw rates go up. It was pretty bad. And it's this last bullet point. It was at the high end of investor expectation. So basically it's that number 2 bullet point, 6 additional rate hikes of 1/4% this year. And so the mortgage market had already moved in anticipation of the 1/4%, but then they continued to move in anticipation of 6 more interest rate hikes. So nobody has a crystal ball. I wouldn't have bet very much because I knew I had a chance of being wrong, but that's the difficult thing right now, right? And then today we have seen the market rebound a little bit. So they didn't continue to go up. So yeah, thanks, Tyson.
Yeah. Because I think they had announced earlier that it was maybe 4 to 6 rate hikes throughout the year. And then yesterday they said 6. All right. Okay, so this is an interesting graph. The Fed, so what we're going to be looking at here is the percent change over the past 10 years of the Fed funds rate compared to the mortgage interest rate. So this is the Fed funds rate. So you can see it's very stepped, right? Because that's when they meet and they adjust it up or down accordingly. So here's 2018. And that's the last time that rates rose. Now here's mortgage interest rates. So you can see it's all over the place. It responds to a lot more factors than just what the Fed does. But what I wanted to highlight here is that even though the Fed rate will be increasing throughout this year, that doesn't mean mortgage rates are going to continue to increase. So you can see in these highlighted periods, these are times mortgage rates dropped when the Fed rate increased. So you see step ups here, but the mortgage rates are decreasing. And again, here, step ups, but decreases. So before yesterday, this is where the Fed rate was, right at the end of this blue line. So obviously it's gone up since then, but mortgage rates were all the way up here. So we could see these come down this year, even as the Fed rate continues to increase. So it's not a direct correlation by any means.
And I think this graph is a good indication of why I could have been right yesterday and we could have seen them dip down. And if they do those 1/4% increases later this year, we really could see rates move in the opposite direction and come down. So that's an awesome graph.
Yeah. So just keep that in mind, that Fed rate does not equal mortgage rate. And very few people in the general public understand that. So
or the media. I heard a guy this morning. I heard a guy this morning on the news as I was driving in that said something that was completely untrue about interest rates. And so, yeah, that's where people are looking to you guys to be the expert and to help them feel safe about making this decision to buy or sell.
Yep. Okay, perfect. All right, inflation. Here's some interesting stuff on inflation because we talked about this last time, but inflation is the enemy of interest rates. As inflation goes up, so do interest rates. So it was announced earlier this year that inflation is over 7%. That's the highest we've seen in 40 years. We have likely seen the worst of inflation-related mortgage rate increases. All these actions that the Fed is trying to take is to fight inflation. So as long as we trust the Fed and their ability to fight inflation, we should not see any more inflation-related mortgage interest rate hikes. That's the
great
hope.
News.
Yes. And then the Fed actions that they're hoping to curb inflation. So it's here, it's bad, but hopefully we've seen the worst of it and it gets better throughout the year. Okay, this is a big topic, and this is one that has been kind of surprising, actually. So in general, large geopolitical events, war, disease, natural disasters, they push people towards safe assets, bonds, and then selling off riskier assets like stocks. And that drops mortgage rates. So when Russia invaded Ukraine, that is usually one of those events that we would expect to see a significant interest rate drop. But we didn't. When it initially happened, it seems like it went down a lot, but
and then went back up.
But then it went back up. And so one thing that I read from one of the sources I was studying is that during these situations, a lot of times the market goes between hope and fear. Like one day it's looking really bad, and then there's peace talks supposedly, and things get a little better. So it's actually been quite a roller coaster throughout this whole Ukraine invasion. Mortgage rates have been up and down, up and down, up and down, and kind of the net effect is kind of been the same. It really hasn't dropped significantly or increased significantly. So, which is surprising to me. I would have expected a bigger drop in mortgage rates. And if things get worse, it could happen. So we're not obviously it's not resolved yet. Okay, next thing to touch on real quick. I've heard a lot of headlines using the term post-pandemic here in the United States. Overall, I would say consumer confidence is much better than it has been throughout the past 2 years in regards to COVID, which does increase mortgage rates. But if we look at Europe, so we're going to look at these next two graphs. It's going to show new COVID cases on a 7-day rolling average for the past 6 months. So during this whole pandemic, the United States has kind of been 2 or 3 weeks behind Europe. So we could see trends in what was happening in Europe. And that kind of gave us an idea of what to expect here. So these are the 3 most populous countries in Europe right now: France, Germany, and the UK. And you can see, these big Omicron spikes, but now they're all trending back up. And I guess there's a new variant or something. And I mean, who knows how much longer this is going to go on, but this is the trend in Europe. Whereas right now we're still on the decline after our big Omicron spike. So overall, I think everybody's generally feeling pretty good, but this is another thing in the future that may rear its ugly head again and could bring mortgage rates back down a little bit throughout the year. I don't know that it'll have as big of an impact, even if we do see another spike, because we've been through this how many times already. But it's just another factor that could be a player throughout the rest of the year. Okay, so overall, what does all this mean? All these different factors. So the Fed actions are tending to push interest rates up. We talked about the Federal Reserve rate, and I put in MBS, which stands for mortgage-backed securities. We talked about that a little bit last time. But basically, the Fed is not buying up mortgage-backed securities like they used to, and that will also push rates up. They didn't really announce anything specific on that yesterday, but they could throughout the year. Inflation control. So the Fed actions are hopefully leading to inflation control, which will bring rates down. So those, in essence, could kind of cancel each other out. We've got global unrest, we've got COVID. So what does all that equal out to? We don't really know. We'll probably see some ups and some downs this year. Overall, I'm hoping we're lower at the end of the year than where we are now. But there's a lot going on that affects interest rates. Anything you want to add in there, Bliss?
No, I mean, I really want to talk about how to have a conversation with your client, but I think I'm going to wait a minute till you do.
Yeah, we'll get to that.
Cool. Yeah.
So I did this last time. So this is kind of a quick history. So December 2020 was kind of the bottom. And then we went up and down a little bit throughout 2021. This is where we were at the beginning of the year. So this is just a basic conventional mortgage, about 10% down, good credit. You know, this is standard mortgage rate. This is where we are today. So it's gone up a lot more than I would have expected by this point in the year. A lot of analysts in January thought we'd top out at about 4.25 sometime over the summer, but we're already above that. I'm hopeful we will still end up at about 4.25 sometime over the summer, and then by the end of the year, below 4. When we did this in January, my prediction for the end of the year was 3.25. I'm not that optimistic anymore, but I do think we're at the high, and during the year, it should stay fairly stable, and if anything, drop a little bit throughout the year. But again, that prediction is worth the price of admission to this meeting. So
you can Venmo me.
Yeah. So it is really tough. There are a lot of factors at work this year. But again, the hope is that we'll drop a little bit. Okay, a few other things real quick. So if inflation doesn't respond, rates could continue to rise. If the Fed actions fail. China is another big question mark in all of this. There's been rumblings of a currency crisis in China, and then there's been also rumblings of a Taiwan invasion, especially after what Russia did in Ukraine. If they view that as an opportunity, they could move there, and that would drop rates. And then, of course, if the Ukraine situation escalates into more widespread conflict to other countries, that would definitely have a big impact. Okay, quick housing market outlook. I had this slide last time. I'm not going to spend a lot of time with it, but the source is the Kempsey Gardner Policy Institute at the U of U. You can find that report online. I can send it out after this meeting. It's really good. But basically, all we're showing here is that the red bars are how many households have been created each year, and the gray bars, how many new homes. And for years, you can see they were way behind. A lot more new households versus new homes built. So now we're over 44,000 households behind. And we had a more in-depth discussion on that in the last meeting.
That's why there's 20 offers on every house in every price range almost right now, right? So.
Yep. Okay, and then a few other things. So Utah was number 2 in home price growth over the last 12 months. Idaho was number 1. So obviously still a huge supply shortage. So from this time last year, we're 25% down in inventory and 50% from 2 years ago as far as homes on the market. Our current inventory is less than 2 months supply, and a healthy market is about a 5-month inventory supply. So we're still a ways from, you know, a more balanced market where it's not such a seller's market. All right, so what is driving this? So that chart that I showed, building didn't keep up for years. Supply chain disruptions have definitely had their impact on new construction. And then I think all of these things have kind of snowballed into a lack of confidence among sellers.
Buyers have enough confidence for everybody right now.
Yeah. But I mean, it's rough because you think, you know, like, oh, I have all this equity I could sell, but then what? You know, if you're not moving out of state or somewhere else, then you just throw yourself into that pool of buyers that is having a rough time. So all these things have kind of snowballed to where we're at now. And then obviously really high demand for housing. Okay, and Bliss, you wanted to take this slide, right?
I do. I actually met with a past client yesterday who just got her real estate license, and I chicken scratched this on a piece of paper. And she's like, oh, that just totally makes sense. So we kind of added this slide in here. This is part of the reason the housing market is not going to crash in Utah. It is not. And so go ahead and put all your other little things up, right? So, and this is my personal experience, right? In the loans that we've been doing. So a lot of people are retiring kind of in that demographic where they're done with their working years. They live in California, they live back east, but maybe they're originally from here or their kids have settled here. So I've actually done a lot of transactions where people are retiring and moving to Utah. They're still healthy, they love the outdoors, they love the weather, they have family here, all of that, right? Or they're retiring here and they're downsizing. I personally just did that, just downsized from my house that I built 10 years ago, right? And then we have the next one, Tyson, which is new households. So, right, millennials and Gen Z. So I have a 22 and a 26-year-old, not married, but in 2021, we got both of them a property because I could see what was happening to their rent situations, right? And I'm downsizing, don't be coming back and living with me, right? And so you've got this huge demographic of people that now have the start of their careers, they're making pretty good money, they maybe are married, have a first baby on the way, and they want to buy a house, they're stable, right? And then the next one, Tyson. And then we've got the strong economy. Utah is a magnet for corporations and businesses that want to come here. From pretty much any industry you can think of, there is some type of a, they've got some foothold in our economy. And so we have a lot of jobs and we have a lot of job growth. And as long as you have jobs and job growth, you're going to have a need for housing, no matter what interest rates are. Now, it does become more of a struggle for sure, absolutely. But again, another reason why the housing market's not going to crash. And then last one, Tyson, remote work. So I told some of you this story before, but a lot of people are moving to Utah because they can live anywhere. They love the outdoors, quality of life. We actually did a loan for a guy that's a police officer in Sacramento, California. Cannot work remotely, obviously, but he works 4 days, has 3 days off, comes, flies back. His family lives in South of Utah County, and he wants the quality of life and the affordability here compared to where he works. And so we're seeing a lot of that. So all of that is driving housing demand. And that's why we're not going to see a crash. Now, will rising interest rates potentially slow things down? Absolutely. It's already making it so people that I had credit approved 3 months ago, when rates were at 3.5%, they now, the house price of what they can buy, instead of it being 400, is now 350. There's not even townhomes at 350 anymore. So they've become priced out of the market. It's very sad, right? So you are going to see, as rates have gone up, that is going to affect it some, but not as much as you would think, because there are still a lot of qualified people that can still afford the higher price and the higher interest rates. And so any questions on that and how to talk to your client about that? I've had 2 people ask if we can send these slides. Absolutely. We'll email it out, all of these slides and the recording, so you guys can use that on social media. Good question. And I think that's the biggest obstacle as agents that you have right now is, you know, especially people in maybe my age group that went through the 2008 crash. They're like, it's a bubble. That's going to happen again. House prices are going to go down 30, 40%. Well, just look at this screen, right? There's enough people in these demographics that can afford to buy a house. It's interesting. Pretty much everyone I've been talking to in the last 30 to 45 days has either said, I just got a raise, or I'm getting a raise in the next 30 or 60 days. And so incomes are definitely going up. They're having to do that. I think people are having to change their mindset, right? It's coming to a point where both spouses need to work, or you need to be in a situation where you have roommates. Also, instead of that single family home with a yard, you may be in a townhome because that's the price range. But home ownership is such a gateway to wealth. That 22 and 26-year-old, my kiddos, that bought a house last August and November, they've already got $30,000 equity in those two properties. And that's not going to stop. And so we're really in a market where we can educate people. And Tyson, I don't remember what your next slide was, but I wanted to talk about that interest rate question. Was that next?
Yeah.
Bliss,
Oh,
can I mention something?
Yeah, Shelly.
Like like you just hit the nail on the head. Like we as agents or anybody in this industry need to do a way better job of educating people what's happening, because it changes so quickly. And if you see a social media post, yours is a great example, when your house went for sale and people are like, this is crazy, you're greedy, you're all selfish, you know, you guys are manipulating the market. And it's like,
yeah,
all those comments are incorrect and they're uneducated. But if we do a better job of giving the market stats in our area, first of all, you bring value. You're educating everyone what's happening. And I just think we can do a better job. Like the market is changing so quickly. We have to be the person in our community that people turn to for that information. And we have all the information on MLS. Yeah. And I think we just need to do a way better job.
Well, and the fact that you guys are on this call, that says you want that information to be able to share it with your clients. So that, right, you're part of the very small percentage of realtors that get that. And so let's talk about client conversations and questions and some stuff like that. So we already hit this one. Is the housing market going to crash? No, right?
Yeah, I mean, we're getting it from both sides. Supply is low and demand is high. So
yeah, absolutely.
Simple answer there.
All right. This is a question, and I've got some great talking points for you on this. And so if you kind of paid attention to some of these other slides and things that Tyson was saying, really, he and I both feel we're kind of at the top of interest rates, and they've already moved in anticipation of what the feds are going to do all day. But what the consumer is hearing from the media is that interest rates are going to go up 6 more times this year, right? What I'm telling people right now, I have someone buying a second home down in Cedar City, right? And their second home interest rates are pretty high. It's expensive right now. But if he doesn't buy that property right now and he waits potentially for interest rates to go down, that house price will be $30,000, $40,000, $50,000 more. But if he buys it now, the payment's a little bit uncomfortable, but he can afford it. My prediction is that within 12 to 18 months, we're going to see a dip down in interest rates where we can do a refinance with usually very little cost to the consumer and get their interest rate down. And if they have mortgage insurance, possibly even getting their mortgage insurance reduced or taken off because their values have gone up. But they have locked in the price of the home by buying now. So even though interest rates are kind of at that top, they have gone up a lot. It is making it more unaffordable. It really is an amazing time to buy a house because you're going to lock in a price that you may not see again. And so I think it's really important to have that conversation with your clients. Interest rate isn't that big of a deal. Now, I know that's like blasphemy, right? When you say that, but hear me out. I've been doing this 31 years come July, 31 years. And I can't even begin to tell you how many people that have gotten into a house and refinanced. In fact, there's a lot of people on this call right now that I've helped you with refinances. You know what I'm talking about. And so even though this interest rate right now is painful, you're probably not going to be in that interest rate all that long. And then you're going to have an opportunity to be able to refinance, get it more manageable. And like I said, if you have mortgage insurance, get that reduced or taken off. So any questions about the interest rate conversation that you guys might have, just unmute yourself and go ahead and ask it. Or thoughts from you, Tyson?
No, you said it very well. And I think that's the thing people just need to understand, because before I was in this industry, I always thought of a mortgage as something very permanent. But right now, the bigger enemy is housing appreciation and getting priced out because houses are too expensive rather than interest rates, because interest rates will fluctuate. There's a lot of forces pushing rates up and down. So yeah, like Bliss said, we think that most people that are buying now will be able to refi in less than 2 years.
Yeah.
So yeah, it may sting just a little bit when you get that initial mortgage, but it's not permanent, and you're gaining equity if you buy now because of all the reasons we already talked about.
I think my favorite quote is the best, because I love the mountains and trees. The best time to plant a tree is 20 years ago. The second best time to plant a tree is today. And that applies so well to the housing market, right? It is absolutely a phenomenal time to buy a house in the state of Utah. Even though there is some hard things about it, but we need to have that conversation. We need to look at that number and help people look at their budgets, right? And understand what it's going to take to get into a house. And that's what Tyson and I are here for, is to help your clients really feel safe, right? Feel calm about that decision to purchase a house and what that means for their finances, not only today, but 5 and 10 years down the road. My dad bought a house about 18 years ago. It's a 2-bedroom condo built in the 60s in Huntington Bay, California. And it has a dock, so it's on the marina. And he paid $330,000. And he moaned and he complained about that house for a very long time. And it's now worth $1.3 million, right? And so, but to him at that time, $330,000 was highway robbery, right? And so I think putting it into perspective into your clients and really helping them see the numbers and see the potential of what that house could do. And again, take them on that path to financial stability through home ownership. I've seen it in my life. I've seen it in my kids' lives. It changes the trajectory of your life to get into home ownership. And I know that sounds dramatic, but there's a lot of truth to that. And so I think having those conversations, and we're happy to help you have those conversations, because they may hear it from you, but it might not sink all the way in, and they need to hear it from somebody else as well. And so that's kind of where we work together as a team. And I think that's what you were going to talk about next, Tyson.
Yeah, and I had one other slide just with a question that I'm sure everybody's heard, or a statement, I guess. I just need to shop around for the best interest rate. It's if you're an agent, I imagine, and you referred them to, a loan officer that you trust, someone you've worked with in the past, and then you hear this, it would make me cringe a little bit, just because that is an integral part of the transaction, the financing, that if it gets messed up, all your hard work, especially in this market, like it's tough to be a buyer's agent right now. Like it's a lot of work. I've seen it. I've seen, you have to show so many houses, put in so many offers most of the time. And so what we wanted to talk about kind of in response to this question is the aspect of helping buyers get into a house, because that's a big concern right now. How can I get into a house in this market?
And I'm actually going to share a quick little story right now that I just am going through right now with an agent. She called me and she said, I have my client are using a lender, and the lender had them credit approved, but misunderstood something on their bank statement. And when they found out that it was a gift from a family member, they said, oh, you're going to have to wait until that money is seasoned. And I'm like, what type of loan are they doing? She's like, conventional with 5% down. I said, that's actually used to be the rule. And it's still the rule with Freddie Mac, but on Fannie Mae, 100% of your down payment, closing costs, everything can be a gift from a family member. So that's a prime example of that borrower hearing from their lender, you're credit approved. Oh, wait, no, you're not credit approved. When in all actuality, they absolutely can buy a house today. And so that's where we like to talk kind of about that team and working with people that you trust. So yeah, just wanted to throw that in there, Tyson.
No, yeah, perfect. So really it is a team effort at this point. And I think what's important especially for you guys, is to really leverage all the relationships you've built so far. Regardless of how long you've been a real estate agent, you have relationships with other agents, with lenders, with title companies, and each part of that team you can use to your advantage. If you see a listing that would work for your buyers and the listing agent, like use that relationship. You trust each other. use, like I mentioned before, lending is a huge part of this. So ask about the lender. So even if you refer them to someone you trust and they choose someone else, I mean, ultimately it is their decision, right? Who they want to use as their lender, but ask them questions. Is it a local lender? Is it somebody that you can contact after hours and on weekends? Because putting in an offer, that's when a lot of offers go in, right? After they get home from work on the weekends. Having a lender call a listing agent can really tip the scales. Listing agents should be reaching out to lenders, but they don't all the time. And so we like to preemptively call before they reach out to us and really put in a good word for our borrowers and make sure that the seller knows that the financing is solid and that's a piece that they aren't going to have to worry about in this transaction. Title companies, I don't know if a lot of agents realize how closely we work with title companies and how critical it is that title companies respond to us when we're
how
trying.
frustrating it can be. I have a closing delayed 2 weeks because of a title issue that if we'd known about it upfront, could have been resolved upfront. And so, please, please, please have a good relationship with a title company and beg your people to use them.
Yeah. And so if a seller is pushing your buyer to use a certain title company and you don't know anything about them, push back on that. Say, no, I prefer that we use this title company because I really trust them. I know they do a good job. So anyway, it's, all hands on deck in this kind of market. It really is a team effort. And that's what we're trying to push when we talk to our borrowers. Going back to that, I just need to shop around for the lowest interest rate question. How I address that, because all the time we don't have the cheapest rate, the lowest rate. A buyer in this market can go out and shop 100 different companies and look for the absolute rock bottom lowest rate. But at the end of the day, if that lender can't pull through on the financing, they're not going to get a house. So
I've actually seen recently where a listing agent and a seller said, you have to get credit approved and use a Utah-based lender, right? And sellers are in the driver's seats, right? I don't know if it was Bank of Arkansas or who it was, but they're like, nope, we like your offer, but we don't like your lender. And so working with a local-based lender, I think is actually an advantage in multiple offer situations as well.
Plus,
Yeah.
I was going to say, if you can't get under contract, it doesn't matter who your lender is. If we can't get a hold of the credit union on the weekends when we all work. So when people are like, the rate matters, the rate matters, but it really doesn't matter if you don't get under contract.
Well, and I'm going to go back to that other question. Rate is important, absolutely. And we have very, very good rates. But how long are you really going to be in that mortgage at that rate? And as a team, my rate, and usually it's not even my rates are different. It's my fees might be a tiny bit different, right? But if you get a house, Shelly, you're right. Okay, so you might be able to get a 4% rate, but if you can't get an accepted offer on a house and then perform and close on time, that 4% did you no good. You really didn't get it.
Right. We need someone who can close quickly and is available to get a hold of. I mean, all of those things really, really matter to get under contract. So Rocket Mortgage, we don't have their cell phone. So it really, really matters.
Well, and Tyson, will you share your experience with, we won't mention that it was Rocket Mortgage, but.
Yeah, it was the spaceship lender. So it was, when I was putting this together, I was just doing a little bit of interest rate comparison to see how rates moved across other lenders, with their investors and how our investors shifted with the news yesterday. So I looked up that mortgage lender online, and they had pretty good rates, but they charge insane amounts of fees, like 2 and 3 points, which we charge half a point usually, like for an origination.
We can basically give the exact same rate as them.
Yeah.
But I don't think it's worth it to pay that much in points when you probably are going to refinance in the next 24 months.
Exactly. And then a Utah company, our favorite billboard lender, all up and down the freeway, they have some cool online tools, like you can go in and put in your situation and they'll give you a quick rate quote. But I was shocked that it is not what is on the billboards. Like, I could not put in a scenario that matched what they're advertising on the billboards. So I'm not saying it's illegal or deceptive, but it's not correct.
And that's what I
So
hear from consumers that end up going there, and feedback is that, yeah, for this reason and this reason and this reason, I couldn't get what was on the billboard. So I don't know.
Bliss and Tyson.
Yeah.
I had a client that used Rocket a few weeks ago, and in the last 4 weeks of him buying the house, I had 4 different contacts with Rocket Mortgage. It changed 4 times in 4 weeks,
Wow.
and it was just impossible to get a hold of anybody, even during normal business hours, let alone the weekend.
Yeah. Thanks, Chris. I appreciate you sharing that. And again, you know what? We're here to offer our services and our help. We'd love to work with all of your buyers, but your buyers have a choice. And so we get that, right? And we don't have time to help everybody, but we really, really excel at customer service, not only to your borrower, but to you, to the listing agent, to the title company, because to me, that's my business model, right? That's what I've based everything on with our team and everything, because that's how I want to be treated when I do something, whether it be inside or outside of mortgages, right? And so that's why we offer these classes and do all of this. So we're just happy to help you.
yeah, and really what I hope you guys take away from this is that because this team concept is something we've adopted. Like once we credit approve a buyer, we say, okay, now is your time to form your team. Like if you're talking to other lenders, fine, but you need to make a decision at this point. Like you don't want to be shopping lenders, the day you're under contract, because then it's go time. And so and same with agents, if they're interviewing a couple agents, we say the same thing. And if we've got that referral from one of you guys, we'll say, hey, we love this agent for these reasons, and now is your time to choose your agent, so that they commit to you before you've shown them 15 houses and then they, change their mind.
Really
So
important.
even if it's not us that's the lender as part of this team, make sure you've got your team together and that you trust everyone on that team. And it might be a new lender that, is your buyer's cousin, but call that lender and say, do a little bit of vetting. Like that can go a long way. That if it doesn't sound like they know what they're talking about, maybe they don't. And that might put the whole transaction in jeopardy.
At risk. Yeah, cool. Thank you, Tyson, so much. Appreciate everybody taking the time and listening to this. And again, we'll do it the next time. But if you have any questions after the call, reach out. Tyson will get everybody the slides and the recording. I think we'll probably put that online and on YouTube, so everybody has access to it. And I hope you all have a great and a happy St. Patrick's Day. Oh, we did green. Yeah. All right, guys. Thanks so much.